Government figures and estimates show that there were just over 1.15 million residential properties sold last year in 2025. Around 230,000, or approximately 20%, were purchased by investors. 80% were bought by people wanting to live in them. Looking at just the investment properties, about 65,000, which is around 30% of the 230,000, were purchased using buy-to-let mortgages, and the majority, around 70,000, which is over 165,000, were purchased using cash. Today, I'm going to talk about the pros and cons of using mortgages to buy rental property. Now, many investors want to be 100% passive owners as they don't want to deal with tenant or maintenance issues or take on the risks and liabilities of the landlord. With the Renters' Rights Act, those liabilities have increased. And in this video, I also explain how you can own property and have none of those risks and why it can be easier to do this if you're buying with cash rather than a mortgage. Hi everyone, I'm Dr. T and I've been in the property business for almost 50 years. Here's a bit about me. In the 1980s, whilst working as a junior doctor, my hobby was computers, and I co-founded one of the UK's largest PC manufacturers with over 3,000 staff. Computer making moved to China, and during the past 17 years, I researched and analysed the UK property market and developed a property business for 100% passive investors, which currently looks after almost 3,000 properties and is now run by my children and over 100 staff. I really enjoy helping people with property investment and making videos like this. Please hit the like button, drop a comment below, subscribe, and hit the bell. Let's get back to the video. So you want to buy a rental property. Most buyers use cash, but when should you consider using a mortgage? Well, the big two advantages of mortgages are firstly, the ability to leverage your funds, and secondly, to buy a property when you don't have enough money. Mortgages are really good when interest rates are low and property capital growth is high. In such a case, you can leverage your money to get more property. For example, get two houses instead of one, and benefit from higher capital growth whilst your net rent can easily cover the interest payments. Usually the main advantage is the capital growth, as much of the net rent is used up by interest and mortgage costs. Mortgages are also good when you don't have enough cash to buy a property outright. So with £40,000 of funds, you can easily buy a property over £100,000. So these are the two main benefits. On the other hand, there are six main disadvantages of mortgages. These are risk, debt, uncertainty, higher cost, delay, and higher tenancy liabilities. Firstly, the risk is there as buy-to-let mortgages are not regulated in the UK. The lender can call in the loan at any time and without giving a reason. Normally, they only do this if you don't make the regular interest payments. This may happen if you can't afford them because interest rates rise, or if your rent can't cover the payments. For example, the tenant doesn't pay, or property is vacant, or repair costs are too high. They can also call in the loan if property prices are crashing and the lender believes there is a risk you'll end up with negative equity, where the value of the property becomes less than the mortgage debt. If they call in the loan and you can't pay it, they can repossess your property and sell it at an auction and charge you for the shortfall. So risk is the first issue with mortgages. Secondly, with buy-to-let mortgages, the investors just pay the interest. Normally, the debt is not repaid and remains outstanding. So investors are never debt-free until they repay all the mortgage or sell the property. But most clients buying for long-term investment want to keep the properties for pension-type income and not sell, so they remain in debt longer. So remaining in debt is the second issue. Thirdly, there is uncertainty as the mortgage may not be approved. There are approval criteria for both the individual and for the property, and the lender may decline in the end, even when there's initial pre-approval. To get approval, if you're not UK resident, is almost impossible, or there are conditions such as higher interest rates or approvals only for higher value loans. For example, those borrowing more than £200,000 per property. These conditions mean the mortgage is usually not worth taking. If you haven't subscribed yet, now's a good time. We publish content every week on UK property investing. Hit the bell and like. It really helps the channel and ensures you're notified when the next video is released. Fourthly, the transactional costs are higher as there may be broker fees, mortgage arrangement fees, valuation fees, and additional legal fees for a lender-approved solicitor, which you pay for. With a mortgage, the tax you pay on rent can be higher under personal ownership as you cannot reclaim it as an expense. So it's almost essential to buy using a limited company, especially if you're a high-rate taxpayer. So you have company setup and maintenance costs as well. So overall, your costs with a mortgage are much higher than a cash purchase. Fifth reason, there are delays as the lenders have to follow a set process, and typically mortgages take several months longer than cash purchases. And finally, in my opinion, the biggest issue with mortgages is that the owners cannot be 100% passive investors. This is because they need to be active landlords as per the requirements of most lenders who don't allow subletting. With a cash purchase, it's much easier. Buyers simply rent their property to a professional company, such as the sponsor of this video, who agrees to become their tenant and takes on every cost and every liability and pays them a fair rent. The company then sublet to their own tenants who get, on average, a higher rent than they pay the investors and pay for and handle all the landlord liabilities and costs. With the Renters' Rights Act, the liabilities and costs of active landlords have increased. So for many buyers, it's essential for them to remain 100% passive investors. But many mortgage lenders don't allow subletting, so this is not possible and is a big downside. So these are the 6 disadvantages of mortgages, and these are the main reasons why cash sales account for over 70% of rental property sales. Please watch the short message from our sponsor at the end, who deal with low-cost properties that are affordable and can be purchased with cash. They also have special deals such as the 2-house offer, the 2-step process, and the 3-house deal that are designed to compete with mortgages. They deliver more property with less money by utilizing future rent in a tax-efficient manner and without any interest or debt. And all of their properties can be purchased 100% passively. Thanks for watching.
If you want to invest in property and get 7% net rent, long-term capital growth, no costs or liabilities ever, do nothing yourself, and be living anywhere in the world, then consider Find UK Property. They provide 100% passive investment solutions for long-term income from freehold properties starting at under 80k. You get a property that is affordable, fully renovated, already rented out, contractually guaranteed and productive from day one. You become the owner and rent it back to Find UK Property so that they become your tenants and look after all aspects of the property in a fully compliant way. You never need to deal with tenants, estate agents, or do any property maintenance or repairs, or pay for any costs. Find UK Property look after over 2,500 houses, all of which are sublet to their own tenants. And on average, they get more rent from their tenants than they have to pay the property owners. So that way they can cover all the property costs. Their solutions are great for those wanting to retire on pension-type income or gradually build large property portfolios passively in a tax-efficient manner. Please visit the website at findukproperty.com and speak to a consultant today.